2017, the then Federal Reserve Chief, Janet Yellen, expects no new financial crisis in our lifetime. All of a sudden, where she said, never going to see another financial crisis in our lifetime, I think things have improved, but then I think there are gigantic holes in the system, Yellen says. The former Fed chair cites leverage loans as an area of concern and says there remains an agenda of unfinished regulation. What's she saying today?
Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now?
Bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is your plan?
And we made that determination.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're
it's-
fully insured no matter what the amount is if you're in a big bank. You're not fully insured if you're in a community bank.
Janet Yellen flip-flopping and having a lot of trouble. SVB's loans to insiders tripled to $219 million before it failed. That includes, loans to officers, directors, and principals, shareholders, and their related interests, more than tripled from the third quarter last year to the final 3 months of 2022, when they already had regulators in there that was flagging problems. And so, when these banks fail and other banks absorb the good parts and they leave the garbage over at the FDIC, which you and I are responsible for. So how about this? Fed borrows $184 billion without congressional authorization, circumventing the debt ceiling. Isn't that interesting? In the past week, the Fed's financial statement shows it borrowed an additional $143 billion to fund the FDIC's bailout of Silicon Valley Bank and Signature Bank. $143 billion. The Fed borrowed these funds and lent them to the FDIC to keep these bank failures from reducing the Treasury's cash balances. How about they borrowed them and loaned them to the FDIC because the FDIC only has $128 billion in the DIF fund? It may have some impact on the Treasury's cash balances because, of course, we're at the debt ceiling and we haven't seen an approval to lift the debt ceiling. I'm sure we'll see that pretty quickly. But how about so that it was obvious or not obvious that the DIF fund, that garbage deposit insurance is exactly that, garbage. Fed borrowings do not count as U.S. Treasury debt and are not counted against the Congressional Treasury debt ceiling limit. I mean, come on. We are so naive. The Fed borrowed $143 billion from the U.S. Treasury to lend to the FDIC to bailouts. The DIF fund that's supposed to fund these bailouts only has $128 billion in there. So these two banks would have more than wiped out that DIF fund. So for anybody that tells you, but we're insured, it only works this is counterparty risk. And any contract that that has counterparty risk is only as good as the entity on the other side of that. When investment risk-taking banks were merged with deposit-taking banks, we had the 1929 collapse. And so then they separated those two banking entities, and they put in that FDIC insurance. Well, that was really about confidence because this is a con game. While this used to back our currency, the only thing that backs it now is the full faith and credit. But this has been coming about for such a long time because that was the beginning and this is the end. So in 99, well, they started setting things up. Clinton signed legislation overhauling the banking laws because, hey, we never learn. And after all, this time is different. I can't even tell you how many times I hear it, but it never is. And so what they then allowed the banks to do, and by the way, this is after they changed Reg D and put in sweep accounts. So you make a deposit, the bank sweeps it into sub-accounts in their name, and then they can use that, and it also reduces the reserve requirement that the banks had to hold for your deposits. But this now in 99 allowed banks, security firms, insurance companies to merge and sell each other's products. Isn't that great? Number one, do you remember this? Because we talked about it back then. Maybe you weren't a viewer. But back in 2019, wow, the Fed is going to operate in a regime of ample reserve supply. What does that mean? They're backstopping all the banks, but no more reserve requirements. They go to zero. So all of this talk, if you're listening to the talking heads on TV, so shocked that this could possibly happen because, you listen to one guy and they say, well, this isn't a solvency issue. This is a liquidity issue, except for all of the liquidity that's been pumped into the system. Where did all that liquidity go? Bought a whole lot of good stuff, a whole lot of tangibles, I'm telling you right now. Hey, they're going to finally, also 2009, finish rewriting the Volcker Rule completely. The Volcker Rule was about proprietary trading, which is risky trading, which is speculation. Because in 2020, this is a statement of Commissioner Allison Heron-Lee on the continued repeal of the Volcker Rule because the Federal Reserve proposes weakening the Volcker Rule. The Fed proposed, and you trust them to manage CBDCs, central bank digital currencies? Are you freaking kidding me? You think they have your best interest at heart? Oh, no, no, no. In part one, I showed you they hadn't even finished writing all the laws when they started to dismantle it, let alone actually make banks comply with it. They were very selective in that. The one rule they did not dismantle, by the way, are bail-ins. Now, we've had 2 derivative explosions so far. We had the first one with long-term capital management in 1998. And it's a very similar thing that's happening right now with the banks rushing in to keep it hidden from us. That's what they did when long-term capital management exploded in 98. Wall Street and the big banks went in and bailed that puppy out, covered it over. Did you even know we had a derivative implosion in 98? Probably not. That's the goal. Keep this hidden so that you do not change behavior, so that you keep your money in the stock market, in the bond market, so these derivatives can play off of the price action above that. But what are they raising it to? What does it mean if they don't have the funding in there to begin with? What are they going to have to do? Well, this is what they're going to have to do again. But frankly, insanity is doing the same thing over and over again and expecting different results. I don't personally think they're insane. What I do think is that they want this financial crisis. In fact, I know that they need this financial crisis to shift us into a new system.